Microsoft is pouring literally billions upon billions of dollars into artificial intelligence infrastructure right now, and honestly, the entire market is holding its breath. We are heading into an incredibly pivotal earnings report, and there is this massive tension building up on Wall Street. The core issue boils down to this. Can Microsoft's foundational cloud growth maintain its blistering momentum, or is this unprecedented wave of AI capital expenditure going to severely crush their legendary profit margins? This isn't just about one company's quarter either. This is a massive test for the entire artificial intelligence narrative that is currently driving the stock market. So that brings us to the ultimate high-stakes question hanging over this entire earnings call. Can AI revenue actually justify the massive cost? Look, Microsoft has made a historic multi-billion-dollar bet on the future of computing. They're building out infrastructure at a scale we have rarely seen in modern tech history. But investors? Well, they're demanding proof of concept. Is this monumental bet actually paying off right now in real dollars and cents? Or are we looking at years of heavy cash burn before the revenue finally catches up? Microsoft is essentially the bellwether for the entire tech sector right now. How they report on this specific dynamic is likely going to dictate the momentum of the entire S&P 500 for the coming months. Let's break down this matrix row by row, because this is the exact scorecard the institutional market will be using on earnings day. First up, Azure growth. Investors are looking closely at overall cloud demand and the specific adoption rates of AI services within that cloud environment. Second is AI CapEx, or capital expenditures. This is the physical side, right? The land, the data centers, the incredibly expensive GPUs, and the massive networking gear. Third, we have margins. This is really where the rubber meets the road. Investors are laser-focused on the direct impact of those massive infrastructure investments on the company's bottom-line profitability. And finally, guidance. Remember, Wall Street doesn't just trade on what happened yesterday. They trade on what's going to happen tomorrow. If forward guidance is weak, past earnings beats simply do not matter. Management's full-year outlook regarding future demand is going to be the ultimate catalyst for the stock price. Moving right along to Section 2, Azure, the growth engine. While everyone is talking nonstop about artificial intelligence, we really have to remember the core pillar of Microsoft's current valuation. Azure remains the absolute primary growth engine for this company. Everything Microsoft is doing with AI is fundamentally designed to drive more volume, more compute consumption, and more fierce loyalty to the Azure cloud platform. Honestly, if Azure growth slows down even a fraction of a percent, the entire Microsoft investment thesis gets called into question. To prevent that, Microsoft's strategy relies on integrating AI across three main pillars. First, Azure AI Services, which allows enterprise clients to build their own bespoke AI applications using Microsoft's massive compute power. Second, Copilot integration. This is weaving artificial intelligence directly into the everyday productivity software that hundreds of millions of workers use. Word, Excel, PowerPoint, and Teams. And third, the GitHub ecosystem, where AI is actively helping software developers write clean code faster and vastly more efficiently. These three pillars are meticulously designed to accelerate cloud demand and lock in that sweet recurring revenue. Now, what's incredibly fascinating here is the stark contrast between the digital and the physical. On the left side, we have our revenue drivers, Copilot, GitHub, and Azure AI. These are software services. Historically, software carries massive, incredibly lucrative profit margins, often in that 70 to 80% range, because once you write the code, you can essentially sell it infinitely at almost zero marginal cost. But look at the right side, the infrastructure costs, data centers, GPUs, networking. These are heavy physical hardware costs. Artificial intelligence totally flips the traditional software script because every single AI prompt a user types requires an astonishing amount of incredibly expensive physical hardware and electricity to run in the background. Which leads us perfectly into Section 3, the massive AI price tag. Microsoft is essentially building the factories of the future, but instead of pouring steel and concrete, these modern factories are made of highly specialized silicon and sprawling server racks. Let's detail the physical realities of this AI boom. The company is engaged in a massive data center expansion all over the globe, aggressively securing real estate and power grids. Inside those data centers, they require intense GPU accumulation. They're out there buying up the most advanced and expensive chips on the market, like the NVIDIA H100s, which can cost tens of thousands of dollars a piece by the hundreds of thousands. And to connect all those localized chips so they can successfully process data together without bottlenecks, they need essential state-of-the-art networking upgrades. All of these physical realities act as a massive, heavy drag on the company's operating margins. They are staggering upfront investments that require billions of dollars out the door today, long before the monthly subscription software revenue fully pays it off.
Before we jump into exactly what Wall Street expects from these numbers, if you're enjoying this analysis, don't forget to like, share, and subscribe to Fox of Wall Street for weekly investing insights and stock market deep dives. Section 4. Wall Street Expectations. So now that we deeply understand the ongoing tug-of-war between Azure's growth and massive capital expenditures, we really need to know what institutional investors and top-tier analysts are specifically demanding to see in this upcoming earnings print. Look, the market is not going to blindly trust management's grand vision forever. They want hard, undeniable evidence. And that brings us to AI monetization. This is defined as the ability to convert artificial intelligence investments into measurable, sustained revenue streams. Wall Street's tolerance for massive cash burn is simply not infinite. Investors are laser-focused on whether this monetization is happening fast enough to justify the historic levels of spending we just walked through. If Microsoft is spending $10 billion in a single quarter on GPUs, Wall Street immediately wants to see the $30 a month subscription revenue from Copilot and the usage fees from Azure AI accelerating rapidly. That proves that the initial investment will yield a return that protects and sustains their overall profit margins over the long term. All right, Section 5, Bull versus Bear Scenarios. This earnings report sets up a very binary event for the broader market. Depending on what the numbers actually reveal, there are two distinctly different ways this could play out for the stock. In the bull case, we see sustained margins combined with rapid AI monetization. This is the highly optimistic view, right? It's where the widespread enterprise adoption of Copilot and surging corporate demand for Azure AI entirely justify those high upfront hardware costs. The revenue comes in so fast and reliably that profit margins remain incredibly strong, validating the entire AI supercycle narrative. On the flip side, we have the bear case, elevated capital expenditures actively dragging down margins paired with slowing cloud demand. This is the pessimistic view. If Microsoft reports that they're spending an absolute fortune building out these data centers, but Azure growth is suddenly cooling off because clients are optimizing their budgets, investors will panic. They'll fear that margins are going to compress significantly for years to come, and the stock multiple will aggressively contract. Finally, Section 6, Final Investment Outlook. We've laid out the foundation, the heavy physical costs, and the market scenarios. Now, let's set up the exact playbook for earnings day so you are fully empowered to understand exactly what's happening the second the press release drops. Step 1. Look immediately at the Azure growth rate. Is the foundational cloud demand holding up to analyst estimates? Step 2. Check commercial bookings. This metric tells you about the future contracted revenue pipeline and long-term enterprise commitment. Step 3. Scan right for the operating margin. Did the massive AI capex eat into their profitability this quarter, or did they actually manage the cost effectively? And Step 4, listen incredibly closely to management's full-year guidance on the earnings call. By checking these 4 sequential steps in order, you're going to know exactly how to gauge whether the bull or bear scenario is actively playing out in real time. To summarize the stakes impartially, our balanced takeaways come down to this monumental clash: market dominance versus margin compression. Microsoft absolutely possesses undeniable enterprise software leadership. They have a massive, practically impenetrable economic moat because tearing them out of a Fortune 500 company's IT infrastructure, it's nearly impossible. But that dominance is currently being weighed heavily against the very genuine structural risks of margin impact from these aggressive, ongoing AI capital expenditures. The company is fundamentally sound and incredibly cash-rich, for sure, but its current premium valuation rests entirely on whether the long-term AI math actually works out in their favor. And that perfectly builds to our final question for you. Based on this incredible tension between soaring Azure AI growth and the staggering physical costs of AI infrastructure, are you bullish or bearish on Microsoft heading into earnings? Drop your predictions in the comments section right now before the official numbers are released. Let's see who gets it right. Thanks for diving into this explainer with us, and we'll see you on the next deep dive.